I'm short the 4150 put that expires in 2 days, so I may be the proud new owner of some S&P futures. Tell him what he's won, boys.
That's a double bottom.
If we rally now, I'm going to be pissed because I just closed my last call. So we're due for a rally.
Right.
Nah, that might not hold here.
I closed Qs before we even got to the announcement. I put that on earlier today, and some of the things worked out relatively well before we even got there.
Freaking
Buyers, go away. Let this just drop. Nah, that might not hold here.
I closed Qs before
It's trying to hold it.
Okay.
Damn. 3 wicks at this level right here. Oh, there's the push. Damn, that was the 3rd wick at that trying to hold there. Alright, let's test low day. Come on, give me it. I want this to be, dude, this would be awesome if this is 100%er.
Turn it around. Sugar, we're going down swinging. And let's go ahead and add. Hold up.
What'd I say, Steve? First move faked out.
Whoa. Hello, everyone.
So far.
Sorry. I'll minimize me. What do we care about the least? We could probably cover up QQQ. We could cover up.
Uh-oh. We just
Apple?
got filled in natural gas. Game
Let's cover
on
Apple.
again.
Let's cover TNX. There we go. We'll be down here today. Like we're a gaming channel. How's everyone doing? We all having a great time?
Yep.
Awesome.
Very happy.
It's always a great time.
I had to be careful of
Look at these dip buyers.
they're trying to come in, dude.
They're trying, dude.
They're trying.
I probably should have just taken profit on those puts right there. It was another 20%.
I mean, they got a mountain to climb, though. Okay, here. Let me mess with this a bit more. 1 second, folks.
I'm about to get filled again on this little scalp in the old natural gas. I need one more penny out there. There she goes. Gonna offer it for sale again. I'll sell it all day.
I scare you? Should have.
They keep buying it from me, and then it goes down. They're dumb.
Man, I can't believe oil melted up to 80. I thought it'd pull back before it hit 80 again.
I play this game of I get like 7 success. full scalp. I just want to be short and stay short, but it moves too much intraday to do that.
Makes it makes it spooky.
Well, you get one
I'm
move
gonna get myself set up here.
in the wrong direction, and it's pretty hairy. Even with the micro contract, just this intraday move that we've had today of 50 cents. Well, every 10 cents is 250 bucks, so it's $1,250 in P&L in one day, and that's lately it's been moving at least that much a day. So you get on the wrong side of it for 2 or 3 days in a row, and
Not fun.
Oh yeah.
yeah, it'll hurt.
Then you feel the pain.
Wait, each 12 cents is 250 bucks.
Every 10 cents is 250 bucks.
Holy shit.
12 and a half. They're $12.50 per tick. Per penny. It's a half a penny tick. No, it's $25 per penny, and it's a half a penny ticks.
Oh, I guess I should comment on the interest rate decision. 50 base points was actually, if you go to the economic data form, it says that the consensus was 1%, but 50 I think comes right in. There were some expectations of 75. We saw after the immediate reaction, the market tried to rally up to 420 with this heavy volume that we're seeing, and then we've seen it capitulate since. And volume starting to die down. So people are kind of waiting to see what the Federal Reserve says. We had Yellen earlier today cause this pump. She was coming in very dovish, talking about soft landings and such, something that we've never historically seen the Fed be able to do. And for as far as quantitative tightening goes, they're going to begin QT at a rate of 47.5 billion per month, which will increase to 75 billion after 3 months. So that is going to cause some more pressure on the lack of liquidity in the debt markets, and subsequently probably the stock market as well. We'll see. It's been continuing to be rough. So we just need to see how the market's going to react at this point. And right now it looks like buyers are trying to come through, but we still have no volume here. So we'll need to see how Powell reacts. I want to see if he's going to mention anything about COVID. And I want to see how he's reacting to the continued changes going on in Russia, and probably have a lot of conversations and questions around the commodity markets as well. And I'm sure someone will bring up Roe v. Wade or something completely random, even though he has nothing to do with that, because that's what they love to do. Melting up still. Look at that. That's the go ahead. This is going to keep moving. QQQ wants to push to a new high. Is Tesla leading the way? No. Dow's also coming up. Volume's going to continue to build here.
If the rut goes green on the day, all bets are off.
I don't even have that up. I could throw it up.
Okay. The rut's the only true market left.
Wow, I didn't realize that this was having so many issues moving.
Yeah,
I've been really watching the rut.
It's been weakest. I love that's my baby.
That's your baby.
Yeah, I feel like it's got so much more to it that like you don't get the skewed weighting that you get in like the E-minis. The E-minis just basically track, 10 big stocks.
Yeah. It's quiet. wish I could play some music. I wish I could play, Spotify Top 100 or something.
Play "Sugar We're Going Down" by Fall Out Boys. Or
We could sing it. I mean, I can't get copyright strike. Even the music they play for the FOMC conference will get me copyright striked.
what?
Yeah.
Wow. Well, I guess like if you're live streaming it, you can play it, right?
No. I got in trouble. I got a flag on my account.
Wow.
Yeah.
Because I know you can't upload it, like upload, but I didn't know. So maybe the streamers have different licenses and stuff to do that. I don't know.
Well, streamers you talk about gaming streamers, I got in trouble for
Yeah,
doing.
gaming streamers. 'Cause they play music over their streams. Sorry, this is super unrelated to market, but I'm just curious.
Yeah. No, I mean, it's fine. We're just waiting for it to start. I see that it's
Right.
turned on. I'm going to be switching my screen over here in a minute. My mic just completely came off the stand. Hello. Why? If you're wondering why I didn't use the boom mic, it's in need of repair. The boom stand, not mic. Bro, am I gonna need to hold this like a rapper? What's going on here?
Jesus, look at that swing.
This
I got
is-
stopped out. I got stopped out of my puts, and look at that fucking swing down. Jesus, dude,
Wow. This is.
bro,
This
I
is-
just got stopped out of puts, dog. No,
Is it gonna push beneath it this time?
bro.
That's
That
it
is
was a lower
bitch.
high.
Whoops. There we go.
We're moving expeditiously to bring it back down. We have both the tools we need and
the resolve that it will take to restore price stability on behalf of American families and businesses.
That's a monster fucking.
The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports.
That's
Two
bad.
categories whose movements last quarter likely carry little signal for future growth.
What?
Indeed, household spending and business fixed investment continue to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low
Bro,
of
that's a
4.6%.
bitch. Stopped out of my
Improvements in
puts.
labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
It just goes right back up.
Labor demand is very strong, and while labor force participation has increased somewhat,
Or is it?
labor supply remains
So-
subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 1.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly
Yeah,
production can
pretty much.
proceed.
Yeah.
Most of it.
Disruptions to supply have been larger and longer lasting than anticipated,
Oh.
and price
It's
pressures
gone.
have spread to a broader range of goods.
Ooh,
and
I'm looking
services.
thick.
Surging
The hoodie
prices
doesn't
of
do me favors.
commodities as a result of Russia's invasion of Ukraine is creating additional upward pressure on inflation.
It's going
And
nuts.
COVID-related lockdowns in China are likely to continue to exacerbate
Oh wow, look at that new lows. Nice. Puts are printing. Oh, puts are definitely printing now. Let's go.
And hardship and our thoughts and sympathies are with the people of these. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity
I'm
abroad,
taking my dailies for 100%.
creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation.
That was a quick 100%. That was
We are
awesome.
highly attentive to the risks that high inflation poses to both sides of our mandate,
Stopped
and we're
out.
strongly
That
committed to
sucks.
restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so.
It doesn't recover from this. Not from a move like that.
At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing
UVXY hasn't
increases
broken to
in
the
the
high of
target
the day
rate
yet.
will be
I know. We
exceeded.
need to break
We
16.
also decided to begin the process of reducing the size of our balance sheet, which will play an important role in forming the stance of monetary policy.
I'm glad I took those off, but
We are on a path to move our policy rate expeditiously to more normal levels. Assuming that economic and financial conditions evolve in line with expectations, there is a broad sense in the committee that additional 50 basis point increases should be on the table in the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy.
are they?
And we will continue to communicate our opinions clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal.
Okay, I need to focus on Powell. I closed my trade.
With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook.
There's nothing nimble about interest rate hikes.
Adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Price
I
stability.
look forward to your questions.
Look at all those hands. Ugh.
Nick Timorous of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections in the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. You're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of the imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. There are 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, average curve. We haven't been at that sort of level of a ratio in the modern era.
Yeah.
So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will.
Soft-ish.
Reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
That was negative for me.
I was pretty bearish. Steve Leisman.
Yeah, the economy won't be able to handle it. Economy's already slowing. Signals are very obvious. And this dude's saying that there could also be things outside of their control and make it worse. Volatility wants to drop off, though, and this wants to blow up. Look at that.
What is the reason to really go to the level of the amount of tightening? Thank you.
Sure. So, 75 basis point increase is not something we're considering.
Game on.
What we are
Game on.
We raised 50 basis points today.
We break that 42,
we said that
42.10.
EVIX flies off a cliff.
Yeah, this is gonna explode.
VIX is in $1.70. Buy it now. It's going to 4,300.
Yep. Oh, I just completely muted the stream.
As well as to financial conditions. And
Why
finally, of
is
course,
this
we
not
will be
working with me,
communicating to
dude?
the
What?
public about what our expectations will be as they evolve. So the test is really just, as I
There's
laid
so
it
much
out,
pent up
economic and financial
people that are going
conditions
to
in
be
the broader,
coming if we start
broader
to get
economic expectations.
some
And, I think the
momentum.
expectations are that we'll
Oh, yeah.
start to see inflation
I bought
flattening out.
Taste
And
calls.
not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is
I don't know, maybe
perhaps
just to
fairly
explain
gentle but
this.
flattening out. We want to know. We
My
want to
voice
see
is
some
selling
evidence.
in
We
my
want to really
neck.
feel
5
that
minutes
we're
from
making some
now,
progress
it's
there.
30 points
But I
up.
mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world.
EVX flies
So,
off a cliff, dude.
we're leaving ourselves room to look at the data and make this decision as we get
Below
there.
15 now.
Sorry, but
Markets.
inflation is lower 1 month and the unemployment rate.
I don't know about
is
Say's
higher.
markets.
That we would calibrate towards a
Market's
lower
irrational.
increase in the funds rate, or
I don't think
if
the
those
1 month is not, no. 1 month's reading doesn't tell us much.
Dude, over
We want
420
to
is
see
huge.
evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort.
You
I
get
think
UVX
we
flat.
need to really see
I know, dude.
that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation
What'd
is
you miss?
if we see what we
Fed
expect
meeting.
to see, then we would have 50 basis point increases on the table at the next 2 meetings.
I'm streaming it if you want to hear it. You can also listen to it on YouTube.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that either pushes
calls for them
economic
converted to
activity
6,
higher
dude.
or slows it down.
I
So
do
it's a
too.
concept,
I'm
really.
gonna swing
It's
them,
not
I
something we
guess.
can identify
Yeah.
with any
At this
precision.
point.
So we estimate it within.
You're swinging calls?
I had a lot of
right
rates
here.
Yeah,
I
dude,
had a
we're
lot
over
for sort of
420
2,
now.
3%.
Like,
And
this
also
is
that's
Almost
crazy.
422.
That's an
Blasted
estimate
through that
for
resistance.
an economy that's at full employment and 2%
Jesus.
inflation.
What?
So really,
I wish I went zero
really
to
what we're
dates,
doing
but 50%
is
on these,
we're
I'd be
raising
going
rates
100% on 0 dates
expeditiously
today.
to what we see as a
Literally.
broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial.
I haven't set up another trade yet. I closed those puts.
Financial conditions
And now I'm just hanging.
the economy. So we're going to be looking at the effect of our policy moves
Game
on
on,
financial
bro.
conditions. Are they tightening appropriately?
Game on, he
We're going to be
says.
looking at the effects on the economy, and we're going to be making a judgment about whether we've done enough
That is huge.
to get us on a path to restore price stability.
I'm swinging
It's
these.
that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision.
T-Doc looks beautiful.
Discussion that we as
There's still an
policymakers
hour
don't
left.
really feel. It's you're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Thanks, Joe Powell. Neil Arlen with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation?
You want like
We
here,
don't
you want
really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you see, look at short-term inflation expectations, they're quite elevated. You can look at that and say, well, that's because people expect inflation to come down, and in fact,
put on your
Longer-term inflation
scaling into
expectations
small
are,
bearish
let's say,
positions
reasonably stable, but
in
have moved up.
DoorDash for when it gets crushed for earnings, because I guarantee it's probably up on the day now.
But only to levels where they were in 2014 by some measure.
You want a short Dash?
You can look at
DoorDash?
I think that's
It's almost up on the day, still down 1.4%. I wonder what those contracts look like. That's an interesting idea.
wage price spiral where we see that companies have the ability to raise prices and they're doing that, but there have been price shocks today. So I just think
Tomorrow,
that
or tomorrow,
it
but
takes you
like all
back
of
to
this.
the basic point
Company
is that we know we need to
can't even pull the
expeditiously
food
move
that it's delivering.
our policy rate
Keep it,
up
it's all
to
scrambled up in a
ranges
bag
of
and cold and
more
shit.
normal neutral levels, and we need to look around and keep going. If
I
we
just
don't
feel
see
super bearish on
financial
the
conditions
company in
have
general
tightened
and they're
adequately,
terrible.
or that the economy is behaving in ways that suggest that we
Given
can
these
move
earnings
further
that
out
we've
where we need to
seen,
be. So
when they
again,
do not
you don't see those
perform,
things
they
yet,
get
but I would say
routed.
there's no basis for feeling
And markets
comfortable about
looking
that.
for companies that
It's a risk that we simply
haven't
can't
proven
we
themselves to
can't
destroy
run that risk. We can't allow a wage price spiral to happen.
well,
We
Netflix,
can't
they
allow
gotta prove
inflation
themselves, but
expectations to
not
be
as of late.
unanchored.
Like
It's
just
just
look at
simply
all the different
can't allow it to happen.
crazy
So we'll
TV
look at it that way.
Netflix, Facebook.
Mm-hmm.
Great. Thanks, Chair Cobb. Gina Smiley with the New York Times. You mentioned in the statement both high risks of inflation from Russia and China.
Right.
Obviously, those are very much
And
supply
I don't
shocks
feel
on
that
the
Dash
demand
is a
side.
strong
And
company.
I wonder what you meant to convey by adding them.
I definitely agree.
I wonder what you meant to convey
So
by
I
adding
am going to be
Well,
taking
so we
a bearish
our
stance.
tools don't really work on
Fine
supply
for an
shocks. Our
outside
tools work on
expected
demand.
move,
And
that was probably about
to the extent
so you're
we
gonna
can't
need
affect
extra
really
to
oil
overcome
prices or other commodity prices or food prices and things like that. So
Whoops.
we can't affect those. But there's a job to do on demand. And that you can see that in the labor market where demand is substantially in excess of supply of workers. And you can see it in the product markets as well.
do a couple of
But I guess I'm just pointing out a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headwinds. People are going to be suffering from that. You know, people almost suffer more from food and energy shocks than, but even though they don't actually tell us much about the future path. So the second thing is that they're both capable of preventing further progress in supply chains healing. And so, or even making supply chains temporarily worse. So that they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to
You know what
work
no
out,
one's mentioning
getting back down to your
is
2%
the
mandate
Japanese yen.
require that these supply chain issues
Not even
be
once.
resolved, since you can only handle the demand side, as you said, or will you
This
have
market is
Chinese
begging to be
demand
blindsided by one of these global
other
issues.
supply chain issues don't resolve themselves in order to try to get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2 to 1 job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks. And that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored. And that's part of our job too. So we want to push that carefully. This puts any central bank in a very difficult situation.
Yeah, I would agree.
Not like.
Are you really expecting
Howard
4,300?
Reuters, and thanks, and nice to be back.
Yeah,
So the two questions, one quick one. You cited the 1.9
If that that yesterday.
Ask you, what would be
Nobody listened to me.
would you like to see that come down to?
I wasn't
From
here
a
yesterday.
non-inflationary vacancy to
Yeah,
unemployment.
that's my
And
bad.
secondly, on health fund inflation,
Nobody knows
how much are you
anything.
counting on wealth
Everybody in this
effects
country
of
was wrong with
stock
everybody
markets?
else.
You know, because
That's what I
equity
was
markets
expecting.
were
I
already down
thought there
quite
was
a
a
bit
really
since
good
late
chance
fall
that
for
we
the
were
start of the year. How are you mapping
leave
that
for
out? Household
maybe
consumption, have they come down enough? Do you need
I mean,
even a number
look at
like
the
down in
previous
equity
round.
values to think that
Brutal.
households are
Absolutely
going to
brutal. I
stop
think we're going
spending
back
the way
down.
we
Don't get me
start
wrong.
spending?
I think we're going back down.
In terms of
Yeah, you talking about the 34 to 450?
we don't have a goal in mind.
Yeah, I think now's the time for you to start selling calls into the up move. Selling some call spreads and some call ratio spreads.
Yeah.
Layer into some call ratio spreads as we go up, and cover all your longs. Because we coming back down.
Oh, for sure.
We might see 4,500 before we come back down. We get enough people to cover. These values are brutal.
You think back to 45? That's a.
I don't have no idea.
Yeah.
I think we're going to 43, but I would not be surprised to see us back above 44 and maybe we pass 45.
I don't even think 43 is that much of a stretch. I agree with that. Probably 40. Yeah. We might develop a triple top there, then come back down, and then we'll visit the 4,000s.
Pretty strong resistance, 4350, right in that area.
Yeah.
And the Fibonacci retracement right at that 43 as well. 4350, between 4350 and 4370, somewhere there.
I'm seeing that.
I'm sure calls at that level too. So I don't want to go through that. That would be a little energy for me. Pretty good at taking it.
My next resistance line is
To follow up on your message from the very beginning, what is your message to the American people about when
Calls
they
are
will start
90%.
to feel the effects
My
of
calls are up
a 50 basis point rate increase or multiple
107%.
hikes?
I
Can
know.
you explain to them what that does to their
It's
daily
wild.
bill?
I haven't even been calling anything out. I'm gonna take everything off the table right here
So, for the first thing
and
to
chill
say
for a
is
moment
that
because this is
we
great.
understand, and
Same.
some of us are old enough to
Go ahead.
live
Plenty
through
of
high
time. I don't
inflation.
want to make
And
it. My heart
Um,
rate is
Very
very
unpleasant. It's
Yeah.
it's just something people.
I'm back in profits on T-Doc play.
The first time. You're paying more for the same thing. If you're a normal
That's
economic person,
hilarious.
then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on on gasoline, on energy, things like that. So we understand
to
the
the point
pain.
where I couldn't even hit,
So
and I was like,
how do you get out of that?
It take me
And
3 hours.
it's our job to make sure that inflation of that
Try to
unpleasant
keep my
high
position
nature
size
doesn't
small.
get entrenched in the economy. That's what we're here for. One of the main things
Bad
we're here
things
for.
happen.
Perhaps the most fundamental thing
Bad
we're here
things
for.
happen.
And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less
I sort of
stress
strangle and
and inflation will go down. Now, the process of getting there involves higher rates,
short time.
so higher mortgage rates, higher borrowing rates, and things like that. So
It's even higher.
it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices.
The juice
We'll do it as quickly and effectively as we can.
money.
We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
What do you think about the 60 calendar?
Thank you, Chip. Edward Lawrence with the Fox Business Network. So you've talked in the past about
that
Or what? Say again.
the 60-foot calendar.
On SPY?
No,
On Dow. You said 60-foot calendar?
60-foot calendar. The weekly selling the 60-foot for that 2-day and buying the next week's 60 put.
On the weekly?
Yeah. So the 9-day and the 2-day. I just pull it off at 60 cents.
I have this all unorganized. I'm trying to pull it up. 9-day, 2-day.
Bearish trade. In that situation, you'd want the stock to be at 65 after earnings. So you do like a 15-point down move.
What stock?
DoorDash.
Oh, okay.
The evil company that delivers food.
That delivers the cold food. I had the wrong stock pulled up, so I was like, wait, what is he talking about? The 90 and 2 days, $60. I mean, I like that actually.
You don't just spike trade.
I have spike traded before. It's usually these are some crazy spreads on here actually.
It's like, you don't want to give me my freaking buffalo sauce McDonald's, I'm gonna short your stock.
116 implied volatility on there, but these are coming in at 180. The 60 strike, 180%. Yeah, this is good to sell, good to comfort. Man, these May 6th ones of 300% on the 2-day.
In the 45-day cycle, in the June monthly cycle, I sold the 40 put and the 130 call for $2. And I used that credit to short to finance the calendar spread.
Wait, you sold the 40 and the 140 for June?
The 40 and the 130.
And the 130 for June. Oh wow. That was pretty much.
$2. And to be honest with you, I'm more worried about the 40 than I am the 130.
Yep. I would be in the same boat. You sold that 130 for $2?
Both of them together, a total credit of $2.
Okay. Well, these are made. When did you do that?
A couple minutes ago.
Oh, okay. I thought you did this like a while ago, and I was like, well, these premiums are holding up. Jeez.
It's already come in $15.
Yeah.
See, all you gotta do is short that, and you instantly make money.
Yeah. Whoops.
Just focus on doing
Think the whole market volatility is just collapsing. So if you're short premium,
I like that play. I'm not sure if I'm gonna pick it up. I'm just. Yeah, I don't know much about Dash.
doesn't really pay off.
What?
It doesn't really pay off very large. You're not gonna make a ton of money on that trade. If you do make money, you'll be lucky to make $50.
Yeah.
Inflation down
Like the start of the line.
in the 1980s, and while it
It closes right above 60 and goes into the next week right above 60. Then you
hope
make
of
money.
everyone, would this FOMC have the courage to endure recessions to
That's
bring
what they
inflation
down
down if
the
that
money
were
even for
the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting.
American Airlines, I keep losing my own delta in there.
And making a judgment. We won't be arguing
I got my freaking
neutral rate. It's
natural gas.
the other
Is this what 4:30 today? Jeez, look at this. It's like we're only just now getting the breath. This is a double breath though. Might get some capitulation here. I haven't listened actually to the speech.
I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. But I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't that it wasn't a particular thing. It was that he always did what he thought was the right thing.
And he made all the money along the back and getting his face ripped off.
So that's the test. It isn't a particular thing. I would say we do see though, we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going.
You can only hear my mic and not Pal. Thanks, Chris.
Racial wealth.
Let me adjust this.
Income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to any
Okay,
place, you need
let's adjust that.
Been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is, we have a pandemic, we have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. We have the highest. So we have to look through that and look at the economy that's coming out the other side. And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision for Bitcoin how high to go will be on the table to be made when we reach neutral.
Yeah.
I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really.
Bitcoin looks identical to SPY.
I'll say again, if we do
that's kind of like
believe
sketchy
to go to those levels.
Yeah, I know. I'm about to text him that in the Discord. Yeah, I'm about to message him. Yeah. Yeah.
Mike McKee from Bloomberg Television and Radio.
Bitcoin
balance sheet. Why did you decide to wait
Bitcoin
until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it.
We're testing the
it's not going to have any
13 EMA
significance over time. We just picked that.
We break through that. We're going
publish these calendars on
433
the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain the effect is of shrinking the balance sheet. you run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate.
All right,
really, have the interest rate be the active tool of money. In terms of speaking to the American people, I feel like sometimes I want to remind us really that's what we work for, and it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that. And so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that, so in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting very appropriately, not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 2.80.
My platform freeze, or like the screws get
and that's all through the economy.
78.
We're feeling those higher rates
What's
already.
happening?
And so that is.
Say it again.
Like, I haven't seen the S&Ps move. I don't know if my platform is not connected to the internet. Like, other things are moving, but the S&P.
TOS?
Yes. They're stuck up 78. They haven't moved, but other tickers are moving.
Steve's question about Paul Volcker, there was also a great pain that came with that as well.
Yeah.
Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. You're already seeing that. Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle?
So as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates, and it moves down. Interest rates,
who's going to sell this now?
A little bit less.
Please tell me who's going to sell this.
Spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us
not at this level. Nobody wants to be short at this price.
The economy a footing where
I was at daily calls and I was up 120%, and I'm looking at this move already, and I'm like, there's no way I'm going to greed more out of this. If I had held earlier,
I don't mean cover. I mean, like, because this is not people that were long covering are not going to be the ones that takes this down. This is a result of people that are short covering their shorts.
Oh yeah. Oh, you know what? Okay, I see what you're saying.
So who's going to get short? Who's going to get back short at this price? No, I don't think you're. You might see a little bit of. You might see it bounce off of this level up here, right at 42.75, 42.80. You might see anywhere between. Yeah, right around that level, there's some resistance. You might see some weakness, but I think it's a real possibility. We just keep on building up.
You know what? I think you nailed it. I agree with that.
There were a couple of weak jobs reports, and inflation had actually come, month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got
you had to get. I see what's happening.
Really,
you had to get money out of the ATM so you
that just said no.
go to the
This is a much stronger economy.
and do those
And by the way,
nails.
then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year. But that hadn't happened yet. Anyway, we got it. We got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on. And it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by.
Feeling really stupid right about now. I got rid of those 5.
That's a good thing, as you can have, as we have. We've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. Long expansions are
would
good
be
for.
I don't even want to
good
look
for the
how
labor
much they'd
market.
be
So
up.
that's the way
Let's
I think
see,
about it.
trading.
I think we, our tools work. We have to think in the medium and longer term. And I do think that
300%.
the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Still making money places though. I didn't realize how long I was. This could have been ugly. I think a lot of it's the premiums coming in with the fixes at 250.
All right, everyone. So, rough recap. Sorry, I'm slouching in my chair. Bad posture. I'm actually just going to make a few more changes here, actually. So, I'm going to be doing some buying here. And if you're in the Discord, You're going to know what I'm buying. And not the S&P. It's great to see CRISPR move like that. There's one other stock I want to buy a little bit more of. So it looks like bottoms end. And like New Trader was saying, by the way, today we had actually 4 or 5 traders in at 4 or 5 traders in at one point, which was great. More people have been coming to the stream. You can always hop in and talk to us. We will answer questions to the best of our knowledge, or you can just hang out with us. Lots of people doing that just to try and soak up knowledge, which I always encourage and I'm always fine with because we live stream every single day. Okay, for the recap on Powell though, basically 50 base point rate hike. We went over the I'm going to read it one more time. For the quantitative tightening, we saw we saw the QT will begin at a rate of 47.5 billion per month, which will increase to 95 billion after 3 months. Just for reference, most of you, but probably won't mean anything to you, but it just means that there's going to be less liquidity in debt markets and less liquidity coming into the market. Now, in the high volatility of the market with low liquidity means we get giant swings like we did today. And today, like New Trader was saying, we think a lot of what's going on today is short squeeze, or at least just short covering. And so this market's melting up. It looks like it wants 430, even on the day hitting 426. These moves are insane. And just to paint how insane they are, let me go ahead and just show this screen again. These are crazy moves today. I love them. This T-Dot play of ours came back. And then we can look at these bonds, though, and see that TNX has actually come down, which means it was probably pricing in that 70 base point increase. And so it's kind of down a bit, and TLT's having some wild swings. So even though the market looks like it's fine with these moves, it does seem like there's some confusion in the bond market. We're going to need to keep an eye on that. And the other thing that's definitely caught my eye is this movement of the dollar today. Because if we look at the dollar,
That's the other thing. I don't want to swing anything.
Huge sell-off on DXY.
It's going to be a full bowl.
And so that's also really interesting. Now, one of the things I didn't like is that we never heard Powell mention the Japanese yen or a lot of the global features that could have ripple effects that hit us here in the U.S. And he did iterate, though, that there could be several things that are outside of their control that could hit the market. Although, once again, saying that he believes the labor market will continue to be strong and that inflation is their primary target. One of the interesting things I think that I thought was interesting was that he said that even if inflation numbers start to come down, it'll take more than a month for them to change their trajectory on what they want to do for the tightening market. So, which is important to keep in mind. So even if we see these numbers improve, it might be several months before they come down from these more aggressive 50 base point increases. And even when that inflation does subside, they're going to continue with 25 base point hikes. And so we'll probably also see that quantitative tightening continue to play out. Now remember, the quantitative tightening is what most economists are more worried about. And I think the argument to be made against everything that occurred today is that the economy is definitely showing more signs of slowing than the Fed wants to admit to. And that's because they're simply saying that they can't take 1 quarter of data and a surprise to the downside as a true signal that the market is in a downturn. And they keep reiterating the jobs numbers. Excuse me. It'll take time for that to play out. But when I take a look away from economists and listen to CEOs and some of their comments, when I look at the forward guidance given by companies, some of these issues that the Fed think will go away in 9 months, we've heard a lot of even the semiconductor companies say that this will persist until 2024. So I think, we're going to need to continue to play this month over month. And I think the economy could be a lot slower than the Fed expects. And that's what's been iterated by a lot of these CEOs. Even Apple came out and said that they're expecting to have poor results in Q2. So even though this quarter's reports have looked rough, I am now got my eyes on second quarter and already expecting that to be even rougher. So even though we see this bounce in the market, and then we could see it push to 430, maybe even higher, it could get a little rational, keep pushing there. These moves to the upside tend to last longer than people expect, and the moves to the downside tend to last longer than people expect. I expect this to trend to probably continue for the rest of the year. So as far as this upside move, when this is over and this subsides, I expect new lows to be made in this market, probably a touch at 4,000, and I think we'll visit the 380s or 3,800 for this summer. So that's what happened today. It was a big Fed decision. Wasn't a real big reaction. I think market's a little irrational in its decision making, but it was pretty oversold all over the place. TDAC was the big one that I was looking at for being oversold. We talked about that in the Sunday report. Anyways, this will be the end of the live stream. I hope you enjoyed. We'll have video out this Sunday. I might have another video be coming out before then. We'll see. And I hope you enjoyed this recap. I'll also clip out this recap as well. So catch you later.